Hey, what's up, guys? Welcome back to another webinar. Today is going to be one of the most important topics, if not the most important topic, and that is risk management. I don't know how many traders I've talked to over the years that they just get wiped out of the game. They either bleed their account or they make one bad trade that was way too much size and just wipe their full account out. So you want to go through a couple different things, and we're going to touch on that in this webinar. If you guys have any questions at all, like normal, just shoot me a message. I'll be more than happy to answer any questions you guys got. So let's dive right on in. So, risk management strategies for small cap short sellers. Welcome to this webinar of risk management for short selling small cap stocks. We'll cover essential techniques to help you safeguard capital, manage losses, and make informed decisions. So, introduction to risk management. Number one, identifying the risk. I tell my students all the time, if you guys do not know what your entry level is and your risk, your entry level is going to determine your risk. Because if I get in, say I get in at 130 and I'm risking 150, you should be able to size in accordingly and make sure that you have this roughly the same risk per trade, which also ties into number two, assess the severity. And one of the biggest mistakes that beginners make is, say you're used to trading with 400 shares, whatever. You don't want to just use 400 shares on every single stock, because depending on the range, the price of the stock, all that kind of stuff, it can make the risk be much bigger than it needs to be. And I'll get into a couple of examples here in a little bit. Then something that's a little bit unique to me, I'm sure that other people use it, but my group, when I started talking about this, none of them were like, "What's your red flag criteria?" And I explained to them, I want to know what the float is, institutional ownership, short float, news, sometimes what country the stock is from can be go into my red flag criteria, or at least be something that I'm like, I at least acknowledge that, it's like, for instance, China stocks. China stocks can be super, super trappy. If you're a beginner and you don't know that, and you don't know that the stock that you're about to play is a China stock, you might have to go about it a little bit differently. Size down a little bit, or, make sure you're at the top of the range, whatever it might be. And then monitoring your risk. Risk management is an ongoing process that requires you to monitor your positions, adjust strategies as needed, and stay informed of market developments. And so for me, how I typically do that is I have alerts that goes off on my phone. It's just like a text message. Hey, dude, this stock that you're watching, either it hit your target or it's going up to your stop, and that way I can start watching it. And or position, like say there's a stock that caught my eye, but I'm like, the only way I'm going to short this is if it gets to this level. All right, well, I want to make sure that I have the alert, at a level that gives me enough time to assess the trade and see kind of how it's trading. The volume, the range that it's trading with, all that kind of stuff will be a factor on whether or not I get into it. I have to see the right things for me to get into the trade. I'll just jump in because it's at my certain price. Why risk management matters. I really cannot stress this enough. Risk management is by far the most important thing ever, because this might not click with a lot of you guys, depending on how much of a beginner you guys are, but it really is not that difficult to make money in the stock market. It truly is not. But the hard part is keeping it. And how you keep that is with proper risk management. Risk management is crucial for short sellers as it helps protect your capital, reduces potential losses, and makes informed investment decisions. It's not really an investment, because when you're shorting small cap stocks, it's going to be very, very quick, but it doesn't help, or it doesn't hurt to have more information, filings, all that kind of stuff. And it can be, like some of these stocks are going to be absolutely horrible, and if they're overextended, a more advanced move is, swinging it short, which, I'll talk about in future more advanced courses. But capital preservation, risk management helps you preserve your capital by limiting potential losses and ensuring you can continue trading. Nothing is worse than, I don't know how many traders I've seen over the years that they're great traders. They really truly are. They make, good amount of money. They do so good. And, I know one guy personally. If he is watching this, I'm not going to use your name or anything, but I have a buddy of mine that was up over 100. I think he's 120 or 130 something $1,000 in a year, and he literally blew that all in a week. Which I know might sound like I'm full of shit. I'm not joking. He literally lost it all in a week, and for me, that's because it was horrible, horrible risk management. He had it in his head that he wanted to push his size. He wanted to get to a certain goal, and the market was not primed for that kind of size and the way that he trades. And once you start losing a little bit of money, that's where your brain, your emotions can really turn against you. You can be like, you don't accept your loss, and then it's worse. It just adds and adds and adds and adds and adds. Once you pass the pain threshold that you're okay with, your emotions can really turn on you a lot, and that's something that is a really really big problem with especially with short selling, because your potential for loss, in theory, it's really unlimited. But if you have really good risk management, you should never have to worry about that, which is why this is so important. Loss control. By implementing risk management techniques, you can minimize potential losses and protect your portfolio from significant drawdowns, like I just stated. Informed decision making. Risk management empowers you to make more informed decisions by providing you with a framework for analyzing potential risk and rewards. If you're going to risk, say, 20 cents to make 20 cents, that's not good risk reward. You want to at least go for at least 2 to 1. So if you're going to risk 20 cents, you got to make 40 cents. What's even better is risking 20 to make 60, or really how I like to do it, which might sound crazy, but really I like to risk like as small as I possibly can, 5 to 10 cents, and I'm looking for a big fade. That's how I prefer to trade. Each person has their own style, so. But special considerations for short sellers. Unlimited loss potential, which we've touched on this a couple times, especially in the last couple of webinars. I really can't stress this enough. When people get so stubborn that they're like, "Oh, this is gonna fade. It's gonna fade. It's gonna fade." Yes, it probably is gonna fade, but the thing about being a short seller is you have to have timing, and if you don't have a lot of experience, really, my personal opinion is, once you take an entry, you need to have a lot smaller size, have much wider stops, because you're going to get stopped out a lot at the very beginning. You can't be like me, where I'm like, hey, I want to risk 5 or 10 cents. You're not going to be skilled enough to take those entries. You're not going to have good enough, knowledge of price action, or, the discipline to wait for your level. And that's going to be super hard. Another thing can be short squeezes. Short squeezes occur when a stock's price rapidly increases due to short sellers covering their positions, further pushing the price up. One example for that, I'm pretty sure I have an example of that here in a second. I'll show you. But say you're risking 150, right? So when you risk something that is so obvious, there is going to probably be a lot of people that are risking that exact level, and people will go in, they'll try to grab the liquidity by running stops. And if you don't see the chart pattern before it happens, sometimes you can get the thing that's called slippage. Yeah, you might have like, all right, I'm risking 150. The second you see 150, no joke, especially if it's something that is as cheap as a dollar or something like that, the range might not be that crazy, but it can definitely skip through 150. And if you have too much size, you can really get hurt a lot. Or if it's an overpriced stock, say you're risking 9.25. Well, a stock that's trading $9, that can have a lot of range and it can really rip through the stop, especially like this is saying. When you are shorting a stock, you're selling first. So when you cover your position, you're actually buying. And so whenever, say you're trading with 200 shares, right? That's not going to be anything super crazy. That's not going to make the stock move. But when you have big people, like people that are trading with big size, when they start seeing things like that, I start, not even my positions are not going to move the stock market. But, when you have, say, 15 of me, all right, that's going to move the stock. And so if people start seeing, oh, dude, this thing's going to squeeze, it can make the price move rapidly. And if you don't have a keen eye for that kind of stuff, you can get in a lot of trouble. You need to have data availability. And I've talked about this all the time. My go-to thing is Edge Trade. Really, I love it because I can pull it up. It's very reliable. And within 20 seconds, I can have a clear idea of like, all right, well, would I even trade this? If I did trade this, what levels would I trade it at? I can go through the filings. I can do all that stuff super, super quick. I absolutely love Edge Trade. But whatever you use, you need to be able to see stuff very, very quickly. When something pops up, you need to be able to look at that, analyze, is this even worth my time? If it is worth your time, all right, well, what levels would you get in at? And, is it worth the risk reward? So this is one of the stocks. This is a long time ago. I got, a bunch of notes over here if you want to pause and read it, whatever. But one of the things at the very beginning, so the first thing that I see is this is something that an absolute beginner would trade. And I'm not saying that I would never trade this, but I would not trade this at this level right now where I am in my career, because for me, yeah, it's up from like $1.70 is not that's not even like $1.70. Like, yeah, I guess $1.70 is, no, the volume really doesn't start even coming in until here. So like $1.90, $1.90. I'm already in short before this even has any volume. That for me is super, super sketchy. If you don't have enough volume, it doesn't allow volatility to where you want volume, because it makes it easy for you to get in and out of your position. If you're right, you can get in pretty easy. If you're wrong, which is the most important thing, you want to be able to get out of your position. If there isn't a lot of volatility, the spread can be very, very big, and that's the difference between the bid. Say the bid's at $1.80, and the ask is say at $1.93. That's a big spread difference. You can get filled anywhere in between here if you do a market order, but if you start slamming the bid because you're not experienced enough to short on the ask, then you can get a horrible fill, and then this can happen where you instantly get in a position. And the second you're in a position, you're already down 10 cents. Well, if you're in trading with stupid size like this, which is crazy, then you're already down $120. And that's really not what you want at all. And then, when I talk about risking, a level that is, everyone's risking that level, right? So this is just stuffed out at $2.05. Down here at $1.98, I'll take a trade at $2, risking just over this. Well, if it starts reacting a wrong way, people that have more experience are going to get out of that. Well, the second that they cover their position, like, it's not ready to go down yet, that's going to fuel. It's like putting jet fuel on a fire. It's not going to end well for you. So position sizing and risk allocation. So determine your risk tolerance. How much capital do you have? How much experience do you have? All that goes into determining your risk tolerance. And At the very beginning, I don't care if you have $1 million. Awesome, that's great. You have no experience. So for me, just because you have a lot of money does not mean that you should be risking a lot of money. You should make sure that you are you're determining your risk by how much money you have and how much experience you have. It kind of goes hand in hand, in my personal opinion. So understanding your own risk tolerance and how much loss you are comfortable accepting, because that's one of the biggest things that beginners have a hard time with, is especially when it comes to money. When they start losing money, they lose their shit, and that is not what you want to do. You have to understand that you're trading the process. You're not trading the money, because, and that might sound crazy, but once you can follow the process, say you start out risking $50. Every single trade you're risking $50. So in theory, you should either lose $50 or you should make $100 to $150. Okay, cool. As long as you have a good win rate, you're not, you don't have any outliers where it's like, oh, hey, why'd you lose $300? That's way more than $50. That kind of stuff will start adding to it. But that's also why you need to have a defined max loss. So say your average winner is $120. Okay, cool. So your average winner is $120. What my recommendation is, your max loss should be roughly about like 240s, 250s, because for me, it's not that difficult to get two winners, but the last thing you want, like, you should not be getting a max loss. First off, that is one of the biggest mistakes I think the beginners do, is they will either make money or they'll hit their max loss. Your max loss is like your seatbelt. If you get into a car wreck, you want to make sure your seatbelt's on so that it makes sure that you have better odds of not getting seriously damaged. That's what your max loss is. It's a seatbelt. You don't get in your car to go drive and you put your seatbelt on and you're like, all right, well, I'm either going to get to my destination or I'm going to get into a car wreck. That would be stupid. That is the equivalent of hitting your max loss every single day. If you are trading to either make money or hit your max loss, that's not sustainable. And because if you start having a max loss, say, and I've done this before too, when you have, say, a week where you've hit max loss every single day, that's depending on your size, that can be a lot of money, and that absolutely messes up your head. You need to calculate your position size, because each trade, like with my previous example, if your max loss is say $240, right? Like I said at the very beginning of this, that is assuming that you're trading with, say, a $50 risk. So say you are trading at $1.40 and you're risking $1.50. Cool. Go in with 500 shares. And because that means that if you're really truly risking 150, or say like you get in 142 and you're risking 152. Okay, cool. You got a 10-cent spread. That's 500 shares. Great. You know what your risk is, and that means that the most you're going to lose on that particular trade is $50. Well, if your max loss is 250, what I recommend to my students is don't have more than a maximum of 5 trades. Really? And if you have, everybody has their own way about doing this, but for me, if I have, say, 3 trades and I've lost, I size down. Because for me, it really truly is not about making the money. I have a bad read on the market, and so for me, I size down. Some people, everybody has their own style, but you want to make sure that you're always calculating your risk, because that's what's going to help you preserve your capital. It's not about making money, especially when you're doing things correctly. Okay, cool, man. You risk $50. But like I said, if your average winner is $150, okay, you can get a couple winners in a trade depending on what your style is, whether you're a scalper, position trader, whatever. But as long as your win rate is high enough and you are using correct position sizing so that you're making sure that each trade is the same thing. You're not having like a $50 loss and a $120 loss and a $85 loss and a $190 loss. you're having 50, 50, 50, 50. Okay, well you're really out of sync with the market. So, you start having, 3 or 4 of those. It's like, hey man, you're down 150 bucks. Do you really want to push this? Or would you just, want to call it a day? Maybe it's not your day. Maybe you didn't sleep enough. You're distracted for whatever reason. It gives you more time to assess, the situation. But if you start sizing in crazy, you can never uncover your position. Like back when I used to size in the same on every single trade, I would trade really well, but then I'd uncover my P&L and I'd be like, oh my god, dude, how, like, I'm like 20 dollars away from my max loss. I felt like I traded really well. I did trade really well. The problem was I wasn't using the right size for my risk levels. I would have losses all over the place, and then making sure that like you're understanding different things, not really diversifying your portfolio, but you want to make sure that you're doing I don't know, like that's more of like a more advanced thing. I do believe in invest in some crypto, do investing in some big cap stocks that you have understanding of, and making sure that, okay, like there was one of my mentors. The reason that I like diversifying is, really, I was with this guy for about 2 years. He never had a red day ever. He would have red days on, say, just small caps. He would take one shot at a trade and he'd lose, but he always had swing positions on. And really, those swing positions, he's like, yeah, I lost 4R today on the small cap trade, but I'm still up huge on my Nvidia swing, or his whatever swing it was. And so that is definitely something I highly recommend for people to start learning how to diversify when you start to gain more experience. This is an old trade, and I can tell that this was a disaster trade because I didn't mark it up. I didn't have my thought process or anything. So being a beginner trader, I know that I was probably just going in with way too big size. At the same time, for those of you that have actually watched, multiple of these webinars of mine, I'm not trading correctly, because if you look at this is the ceiling level, and this would be the floor level for me. And so for me, just looking at this right now, if my student would have sent me this, I'm like, dude, why are you shorting way the hell down here? I know in my head, I was probably like, dude, this thing's up from like 1050. This thing's just going to tank. And I let the greed take control, and I wasn't thinking logically. I shouldn't have traded until it was at least at this level, right? Took a trade here. I have no idea how much size I was in. I got cut up. I don't know what happened here. Obviously, I don't have any notes. But then, it pops up, double tops really quick. Up closer to the ceiling. I was probably risking off of this. Short, I covered break even, jumped right back in, added to it, I guess, and got stopped out. I would imagine I hit max loss because I was probably using way too much size. This is a lot of range. In, a 1 minute bar, this thing went from like 1270 to 1370. That's $1 range. That's crazy. You don't want to be using, for the previous examples, you don't want to be going in with like 50 shares right there. If you're a beginner, okay, yeah, dude, to go in with 50 shares. But I mean, you cover down here. Say you did get up around here, like where I should have been looking at, $14. You cover at your first target. That's 1320s. That's that's a good chunk of change. I mean, like, yeah, you're risking $50. So I mean, depending on what your risk is. You probably didn't get in with a huge amount of size, but at the same time, if you're risking up here, this is, say like 1410. Once again, that's like 500 shares. Well, it just drops down here. That's almost $1. That's almost $500. You start start to understand that once you start worrying about the process and learning how to actually trade. That's what I was trying to say is it's not difficult to make money in the stock market, or at least what normal people would consider a decent amount of money. It's hard to keep it and not let yourself get on tilt. And I know I got on tilt because I can tell by just looking at this. I see a lot of emotion in this trade because I mean, look at that. I have 5 entries within 7 minutes. I'm trying to force something. It doesn't work like that. You have to wait for it to play out the correct way. And being back, when I was trading and I didn't have a lot of experience, it's easy to get your emotions caught up, and that's a killer for a beginner trader. Let's see. So this is a example of a setup that I was talking to my students about a couple of days ago, or like a month ago probably. But so this thing tops up here, right? And my students were like, "All right, hey, what would be the best entry?" And I told them, for our rules, anything in here is correct. I'm going to give away a little secret, and I mean, if anybody's actually watching this, then congratulations. But for me, how I trade, or at least not how I trade, but how I teach beginners to trade, because I feel like you want to make it as simple as possible. So if they take a trade in here anywhere, it really does not matter anywhere in here. Your risk is up here. Well, if you're doing it correctly, right? And you're risking, let's just say $100 to make it a little bit easier. So say you get in here, at 290. Awesome. You're in at 290, you're risking 35 cents or 45 cents. All right, so you're going to go in with, roughly that's about $500, right? I believe so. Or 500 shares, I'm pretty sure. But anyways, maybe not. I'm too tired right now to even do math. But anyways, you want to figure out how many shares you can take risking this high up here. It really doesn't matter, but like you're risking $100, right? Cool. You're in at 290, risking 345. Your first cover is going to be down here, right? So if you got an at 390, you cover, half at 230s. So that's a 60-cent move. You're risking 40. That's a little over, like 1.5 R maybe, like 1.3 R or whatever. Okay, that's not super good. But if you're at 290, okay, you're gonna get stopped out break even for my rules, right? All right, you got stopped out. You just made however many cents. All right, well, double tops over here. Okay, well, take it again. Risking over here. Cool. Covers down here. Okay, you cover half. Stop goes to break even. Still doesn't stop you out. Shit, stopped you out. Stuffs slams down. Okay, I mean, like, you can take any of these trades. Even if it hits here, it's still a valid trade. As long as you're calculating your risk is up here. There's a bunch of different places that you can take this trade at, and at the end of the day, it's faded all the way back down to the final target anyways. What the biggest thing is, you want to make sure that if your risk is up here, like first off, if my risk, if I'm taking a trade right here, and I'm risking up here, I'm not covering anything right here. What I would do though is I would take a trade here. This hits, I would lower my stop to break even. Okay, does it get hit? No. Okay, it goes down. All right, well, it got all the way down here. It's at almost $2. All right, well, you got in at $2.75. You're risking 25, 30, 60 cents to make 70 cents. All right, well, that's like 1 to 1. That's not great. But you get down here. No, that's like $2. This is 210. I mean that's really not that much of a difference. But you cover all the way down here, 190s. That's still a good trade. Like you have to figure out that that's not a good trade. But one of these, that's gonna be a good trade. Especially, you're risking 45 cents and you just make over $1. That's a good trade. All right, whatever. And like I said at the very beginning, when you first start trading, you're not going to have the highest, R trade. All right, but as long as your win rate is on and you are learning a little bit better, how I would personally take this trade, it would be a little bit different. But that's why you have to follow the process. At the very beginning, you want to make it as simple as possible. But for me, where I would be taking the trade at would be, I would be taking a trade right here, and at the most, I'd be risking right here. But I might be risking right here. It just depends. All right, well, because that's a whole dollar number, so I'd be going in at 290. I'd probably be risking 15 cents. I'd be like 5 cents over the whole dollar number. Okay, so that's 15 cents. 290 goes down to 230s. Yes, that is absolutely worth that trade. And okay, I cover half. Who gives a shit if I get stopped out break even? But the more experience you gain, you can start tweaking the rules. But when you first start, you have no idea. It makes it super simple because it just comes up here. You take the trade. Okay, say you got 1R. You risked $100. You made $100. Okay, well, as long as your win rate is good, you start adding that up. Okay, like now you're starting to get better. The more experience you get, okay, hey man, start tightening your risk up. Instead of risking all the way up here, risk just over here and make sure that your entry gets a little bit better. Okay, that's perfectly fine. I have one guy that I work with that he hits, right in here, and he covers everything right here. He just covers everything right here. And for me, he's got a high win rate, and so it's like, well, as long as his stats are showing the right data, okay, who am I to tell him that it's wrong? He's being profitable. Okay, then that's working for him. You just need to find what's working for you and your setup, your lifestyle, your time limit, all that kind of stuff. Stop loss strategies. Trailing stop loss means that, kind of how I was explaining, that if I took the trade, I cover at my first target, my stop goes to break even. That is my trailing stop. Some people will be like, if they got at 190 and they cover at 130s, their trailing stop might be at like 155 or something. Everybody has their own way of doing things. The easiest way for me is I'm more of a position trader. I want to get I want to try to sniper in a level. Actually, here, I'll draw it out real quick. This is kind of my thought process really fast. Say this is the ceiling and this is the floor. Okay, cool. So I start seeing this thing coming up. I want to take trade somewhere around there. What I'm looking for is, I might take, a small piece off here, small piece off here, small piece off here, and another piece off around there. That's how I trade. I don't have a trailing stop because what I do personally, I'll take this trade. I'm risking just over this, right? This goes down, hits my first target. Awesome. I'm not risking any more money. I'm playing with house money now because I still have half my size, and now I'm risking break even. If I get to this target, I've already made the daily amount of money that I need to make, 9 out of 10 times. Cool. I already did my day. But the difference is Once this happens, my stop is break even. Okay, well this could trade up. It can start doing something like high, low, high, low, gets just below, and then tanks again. Boop. Sweet. I just covered another piece. Great. Now my stop is still break even. High, low, high, low. Oh shit, dude! This thing, it might squeeze. It might squeeze. You have all these guys that are freaking out about price action and all this stuff, and all of a sudden it's like, bloop, do do do. Like I'm not an artist, but you get the idea. No matter what, for me, it makes it a lot easier because I don't care what the price action does. And how I do it is I do range orders. And for me, that's the best thing in the world because I don't have to worry about it. It doesn't factor in human error at all. I have my all my orders that are going to my targets, and then I have my stop at break even. Okay, cool. And I have an example here in a second. But fixed stop loss. This is what I recommend for beginners. The second you get in, I used to have a hotkey that, depending on what my risk was, say, I would not be like 100% accurate. I'd be like, hey, I'm risking roughly 10 cents. Okay, I know how much shares I can go in if my risk is 10 cents, 15 cents, 20 cents, 25 cents. Like that's about as far as I would go. I wasn't trading very high price stocks at the very beginning, but the second I took my entry, I would instantly hit my hotkey. Okay, cool. I know that my level, and I'd be looking at it like I said, if I was going to take a trade at $1.43, and my risk was $1.50, I would just hit the 10-cent hotkey. Okay, I'm risking 10 cents. If I want to like really be super super accurate, I can even lower. I can click on it and drag it down to the level that I want to trade off of, and that's one way that you can do that. And I don't know. That's how I think that is the best way for beginners to do it. That way, there isn't any human error. You don't want to have something where you're like, oh, if this hits $1.50, I'll get there, because I don't know how many times people are like, oh, I'm going to give it a little bit of wiggle room. This might go down. It allows your brain to run off of something and turn a bad situation into a horrible situation. So I don't recommend that. And then volatility based stop loss, if it's a more like a low float stock or a recent IPO or whatever, you might want to have a very close stop, because especially on like a micro float or something like that. I don't recommend beginners trading those, but if they do, you should reduce your size by a lot. What I recommend to my students is go in half size, really. And if going in half size means you're not going to make anything on the trade, then cool, don't trade it. Or switch. Most brokers allow you to trade on paper anyways, so just switch to paper trading and get the experience, but don't risk your hard-earned capital. But if you are trading with decent size, I recommend that you reduce your risk in half, and you have much tighter stops, and you have rules in place for those kind of like red flag criteria, and everybody's got their own way of doing it. Monitoring and adjusting positions. Once again, like the trailing stop orders, certain people do that. I don't personally do that. What my preference is, I love range orders. That's my thing. I love range orders. I got an example here in a little bit, but like I said, I take my entry. I'm dialed in on the trade. I'm watching it like a hawk, and I know where my risk is. But the second that my target gets hit, boom, range order, done. And for me, that's the best way for me to trade, because then like really I'm really in the trade for, like, no joke, sometimes like 5 minutes. I put 5 minutes of like very very detailed focus on a trade, and then I'm out. I put my range order in. in certain cases, if it's a volatility adjustment, that's one thing that if it's a micro float, I might wait till my second stop gets hit. But I have on my app or on my phone an app where I can pop it up and I can always babysit it. I always have alerts on, and I can get out of it whenever I need to. But this is kind of like you have to find your own style. This is, I can tell you all day how I do it, but if you have a completely different style than me, it's not gonna really amount to much. So this is a very good example of one of my trades from a month ago, I guess. So this thing popped up. Don't really remember if this was pre-market high or what this level was, but I took a trade here. Didn't quite hit my stop, but once it I think it halted up. Yeah, it halted up, popped open, halted down, then started consolidating, and then I'm pretty sure it ripped back up. I stopped myself out. It hit the 150s, stuffed at the 150s, and I took the trade, risking just over the high. Came down, I covered, and then once again, this is a range order. I put my range order in for my next target, my final target, and I was done. And I left the trade. I can't remember exactly how it played out, but this is how I do like 9 out of 10 times. Unless it's a super volatile stock, it's halting a lot. It's a micro float, recent IPO, or if I have plenty of time. That's another factor. I might stick around for a little while and just BS my students or whatever. So it's just kind of like I don't know, plug and play kind of thing. So one of the key things I want you guys to take away from this is you need to identify your risk. When you take a trade, you need to know where is your entry at? What does your entry need to look like for you to take a valid entry? When you take the entry, where are you risking at? And how much size and what dollar amount are you factoring in that you're okay with? Because you don't want to take a trade if, say, you go in with huge size just thinking that you're going to hit a home run, and then it starts coming up to stop loss, and you uncover your P&L, or you look at your P&L or whatever, and it makes your heart just sink into your stomach. That is not something you want to have. You want to find a happy balance where it's not something that you're going to be on like suicide watch if you take a loss, but you want to have enough skin in the game that it makes you respect it, because that's one of the biggest things that I've seen, especially beginners. They don't seem to respect their losses, and they let it get away from them. Mitigate your losses. Employ stop loss orders, position sizes correctly, and other technicals to manage potential losses. And for me, like I said, I have 6 years of experience. I look at the price action and I will get out, and sometimes I'm wrong. That's the difference though, right there. If I take a trade and instead of risking whatever the level is, I see something that I get faked out. All right, dude, I got faked out. Who cares? I missed out on it. I am not chasing that stock, because if I chase that stock, that's going to allow for a potential short squeeze, and that's going to get me triggered. It's going to piss me off. I'm going to go on tilt, and I know that from years of experience. You need to make sure that you're always watching the positions at the same time, because I told this story in one of my YouTube videos, but there was this trade that this is probably like one of the biggest turning points of my career. I had a lot of success at the very beginning. Then I went full-time trader, and that really, it was on and off, honestly. And there was this one time that I got super greedy, and I was up over $2,000. And because I was not monitoring my position correctly, I wasn't managing my risk correctly, I gave all of that $2,000 back, and I hit my max loss. And I remember talking to one of my best friends. I was just like, dude, I don't know what the hell happened to me, man. Like my emotions just went crazy, and he was just like, dude, he basically give me a pep talk and all that kind of stuff, and that's what kind of made me sit down. I went to a park, I sat down with a notebook, and I just started writing. I was like, all right, I started playing scenarios out of my head, and that's what worked for me. Okay, well, if I take this trade, as a gap and crap, what does it have to look like for me to get into the trade? Where do I logically risk off of? And once I cover, how do I react to that? If it gets just within a certain bit of or close to my first cover, and then it curls and goes to stop me out, how do I react to that? I started playing different things in my head, and I started playing scenarios to where I just started writing like crazy, and that's how I formed my own system. And then once again, you have to stay informed. You have to be able to have something, which I'm always preaching all day, every day. Edge of trade. Like it literally takes me seconds to pop this thing up. Good, 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 good. I don't like that. Maybe all right. It's up quite a bit. I don't like that one thing. So you know what? I'm going to go in half size. Or I'll go full size, but I need to see this. If this does not happen, I don't go in. And you start learning that with a lot of experience. And that's just something that I really can't stress enough. I'm really hoping that these are adding value to people, and they're improving your guys' trading. But really, it does not matter 100% what I'm saying. All I'm doing is I'm giving you advice, and that's the thing that I feel like is a lot different about me than most of these guys that are out here trying to teach day trading, because I don't know. I feel like they're more of salesmen. I don't feel like they're not throwing a lot of really good information out there. The biggest thing is finding what works for you. How do you manage your risk? How do you size in correctly? How do you target? Like what are your targets? What are your risks? All that kind of stuff. You have to really find your own style of trading, and that's the thing that takes a long time, which is why risk management is so important. I don't know how many people I've talked to that, they were good traders. They really, really were. But their risk management, different things would make them fall off target, and they'd lose control. And all it takes is, one bad time. Actually, I'll end this with one really big story of something that it could have absolutely been a horrible day for me. So I was with Cobra Trading, and at the very beginning of my trading career, and they had switched their whoever manages their max losses or whatever. I saw the email. I saw the email saying the max loss, and I was like, I don't need a max loss. I'll be fine. I'll trade today. It was right before the open. I didn't want to go in and mess with it and get myself out of the zone. I can't remember what the stock was I was trading, but I do remember it was easy to borrow. And it was during COVID. It's probably like late 2020s, I guess, late 2020s. And this thing's just ripping up. And I am making a ungodly amount of money longing the stock, and I'm having a freaking blast. Well, then I don't know how much size I was in. I was just adding in boom, 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 and all of a sudden stuff. And I mean, this thing just slammed like, I don't know, $1.50 probably. Well, I was like, ooh, that hurt. But like I was using huge size. I was like, dude, I'm still up like quite a bit, and I covered like right before the halt. And I always hide my P&L even to today, because I don't like to look at the money. And really, I still hide my P&L, but I changed my P&L to R, and that way I can see like, oh, you're up 4R. Say you're risking $50, that would mean that I am up $200. Okay, cool. Yeah, I can calculate, how much money I made, but for me, for some reason, psychologically, that makes it easier for me to just kind of digest that. Uh, but when I uncovered it, I was like, oh my god, dude, I was down like I want to say like 3 or 4 max losses, and I was like, holy shit, dude, I just put a huge dent in my account. I remember sitting there. I was just like, oh my god, I don't know what to do. I don't know what to do. I was like, it was too big of a loss for me to be okay with, and that right there allowed it to really spiral out of control. When this thing starts going up, I was like, well, shit. Do I long it? Do I short it? Like, my brain is just like shooting off like 50 million different ideas. All of them stupid, by the way, because I'm triggered, and so I'm like sitting there looking at this thing. I was like, all right, Adam, calm down, logically. All right, so this thing just ripped up. Like, there's a lot of longs that were probably dumber than you and did not cover. So they're probably still sitting in there just praying to God this thing comes back up. I was like, okay. So I know that if this thing goes to do a fake breakout high of day, I was like, I wonder how much size I can go in with. And this was such a terrible moment in my trading career, because this ended up spiraling me into, like, I got really lucky because I thought, like, I got very good at listening to my gut, and it saved my ass a lot. But I could have absolutely just wrecked everything. But this thing goes up, and like I said, it's easy to borrow. Well, while it's going up, I was like, okay. I learned a really bad habit in one of the very first trading room that I was ever a part of, and he talked about how you could, go in with like 95% of buying power. Well, I could go in with a huge amount of size because I had a $30,000 account, and so I was like, well, if this thing gets back up to high of day, I'm going to short it with everything I got. Well, sure as shit, this thing went up. And when it did, I just started hammering it with like big blocks. Boom, 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 boom. And that was the biggest gamble I've ever done in my life. That was not trading. That was just absolutely stupid recklessness that worked. And that was the biggest trading day of my career at the time. And but the moral of the story is, you might be sitting there being like, oh, this guy's, he's full of shit. I don't need a stop loss. I don't need max loss. Yeah, you do. Yes, you absolutely do. Because all it takes is one time for you to do something that stupid and ruin your account, and blow up big enough to where, I don't know, you owe your broker money. I've done that before too. And like I said, I've literally done almost every bad decision you can make in trading. I've pretty much done all of them. So I'm trying to give back to people and tell my experiences, why I shouldn't have done that ever. You should never ever ever do that. Ever. That's not, you never want to break your rules, because the second you start breaking your rules, subconsciously you don't have confidence in yourself anymore, because you don't trust yourself. And that's why I always say you need to trade the process, not the P&L, because if you can start trusting yourself and you get laser focused and you can risk only $50, okay, so you do that for a month or two, okay, sweet, dude, double your size. Now you're risking $100. That's the biggest problem with most traders, is they want instant gratification. They want to go from 0 to a million right now. If you really want to take trading seriously, don't do that. That's what idiots do, and that's why only 1%, or that's the odds, I guess, is 1% of traders actually make it. I don't know if that's the actual number or not. I know it's very, very low though. And it's because most people are greedy and ignorant. And you need to make sure that you are following a structured plan, and risk management is the most important thing you can possibly focus on. So hopefully you guys found a lot of value in this. And if you did, comment down below, like, subscribe, share. And like I said, if you have any questions, just shoot me a message and I will be more than happy to help you guys out. Have a good one, and I will see you in the next one.